Hello everybody, Tortoise Investing coming at you today with another 3 of the best dividend stocks to buy now. Before we take a look at that, we're going to take a quick look at the portfolio, see how it's going, and at the main end of the video we're going to go over analyst estimates for the revenue and EPS for these 3 stocks. Timestamps will be for everything in the description down below if you want to skip around to a certain stock, the analysts, whichever you want to do. Before we dive into everything, please hit that subscribe button, drop a like, and comment down below. Do you own any of these? I'd love to hear from you. All those things help out a ton with the videos, makes the YouTube algorithm happy, and it helps out the videos a ton. So if you could do those things, I'd greatly appreciate it. Now, without further ado, let's take a look. Going to be taking a look at United Healthcare Group, McDonald's Corporation, and Canadian Pacific Railway. Now we're going to start things off here with OUNH 497.12, just a free cash flow yield of 2.06%, dividend yield of 1.69%, and payout ratio just below 46%. Now, over the past 5 years, it's up 102%. Over the past 10 years, up a whopping 535.95%. Absolutely amazing. Revenue growth over the last 10 years, 11.81%, so very nice, up and to the right. Revenue by segment, if you look here, very consistently growing. We got the first one in for 2024. And I'm pretty sure it's going to be right in line, just continuously growing with their revenue by segment. It's a healthcare company. Premiums are huge for them, as you can see, very consistently just going up and up and up. The amount of people that they serve also increasing. It looks like there was a slight bump down here, but healthcare is expensive, but you gotta have it. So, again, this is not something that I'm worried about. I just expect this to fully be up and to the right. I say it went down, but this is for 2024, and we're already almost at 2023, so I looked at that wrong. It's very early, sorry. But yeah, this is like the juggernaut. When it comes to healthcare companies, this is what I think of. EBITDA growing beautifully up and to the right. 13.49%. Take a look at the free cash flow, 15.98%. That is amazing. Absolutely want to see the free cash flow growing with your company because they can use that cash for dividends, share buybacks, reinvest into themselves. So I love seeing that. Now the EPS, 15.81% as well over the last 10 years, just up and to the right. This company is very reliable and consistent with its growth. Now, the only thing that I don't like is as it's growing, the debt is growing. Debt's at $54.4 billion as of last year. EBITDA is $36.33 billion, so it's not an issue. My general rule of thumb, I don't like companies that have more than 3 times their EBITDA in debt. If there was to be a hardship, something major was to happen in the company and they were needing to take out debt, this would make it a little bit harder on them, might make the dividend not as safe. But for right now, I don't view this as an issue. It's not even close to 2 times. Now the dividend, 18.8% over the last 10 years. This is nuts. This is awesome. I absolutely love this. Very consistent mid double digit, up to like 20% at sometimes growth out of their dividend. That is wonderful. Shares outstanding, not too much going on here. Going down to a rate of 0.86%. So they nibble at it here and there. I'm assuming they try to jump in when it's on a dip. There's been a couple of really great buying opportunities even in the last year. I consider anything below 500, like with this company, something to look at. Below 450, very something to look at. Not financial advice. Always do your own research before investing. And the payout ratio, the return on capital employed, it's pretty much been between 17 and 18% for forever and a day. So very reliable there on that front. Next up, McDonald's. Don't want to do the exact tune. They might not like that. Just a freak. 253.58. It is really early. 383. 3.83% on their adjusted free cash flow yield. Dividend yield 2.63%. Payout ratio just a little over 54%. So if we take a look here over the last 5 years at a McDonald's, we're down. We're in a dip right now, almost 15%. Over the last 5 years, 24.42%. Over the last 10 years, 150.4%. This is a very defensive company. If you're wanting something that's very reliable and you want that dividend, you're wanting something that you more than likely, there's a very strong chance that you have to worry about this. McDonald's is going to be around forever. Definitely something to look at, especially if you're looking for a restaurant or a food service in your portfolio. Now, they were growing, and then they kind of went on this downtrend from 2018 to 2020, and now we're growing again. So I'm not 100% sure what was going on there, but we are headed in the right direction, as you see here over the last 3 years. Free cash flow growing at a rate of 5.38% over the last 10 years. Over the last 5 years, 11.42%. So again, since 2017, it looks like for this one, we have been trending in the right direction with the free cash flow yield. So again, you want that free cash flow to be increasing, pay out the dividends, help their company, buy back shares. EPS 7.61% over the last 10 years, not too shabby whatsoever. And when it comes to their debt, $24.1 billion as of last year, sitting at $12 billion right now. Again, that's not 3 times, it's around 2, a little bit over. No, it's right at 2. So again, not an issue, not something that I would be too worried about in my eyes. Take a look at the quarterly, see if it's updated. 36.76, so it did spike up about 12 billion, but again, even then it still falls right into that 3 times ratio. As United Health, we're going to go back because I'm half asleep. 63.85 billion. So same thing there. They took out, United Health took out some additional debt, but it's not an issue. Again, in my eyes, your own research. Okay, back to McDonald's. I apologize for being all over the place, guys. I really want to put out a video for you on Monday. Dividend's going to be growing at a rate of 7.5% over the last 10 years, so up and to the right. Shares outstanding have been decreasing. I love to see this. Over the last 10 years, rate of 3.13%, and it looks like it's still been over 1%, close to 1.5% over the last 5, so they are nibbling at that share count very consistently, and I hope that they are taking advantage of this dip right now. Return on capital employed for 2020, we're looking at 15.77, 20.88, 20.09, and 23.83, so that is growing as well. Love to see that. Next up, Canadian Pacific Railway. We've got a price point of $76.93, just for cash flow yield of 1.87%, dividend yield 0.72%, and a payout ratio of 24.92%. Take a look here over the last 5 years, up 64.17% over the last 10 years, up 111.23%. Now, over the past couple of years, even since 2021, we're 3 years ago, this thing's been just bouncing around like 67 to 90 mark. It's just been bouncing around, and it's like it thought about breaking through here, and right back down we go. So this one's one that I definitely got my eye on. I would love to have a railroad in my portfolio. So if this dips any further, I'm gonna have to buy me a little bit of it. Again, don't buy it just because I am. I just like the company, I like the direction they're going. The acquisition that they recently did, I think, is going to really help them when it comes to their revenue growth and free cash flow generation in the company. And they have already stated that they want to decrease their total amount of leverage. So they're going to be focusing on getting that debt down. Now, revenue. Revenue's been growing over 7.43% over the last 10 years. So over the last 5 years, 11.41. So it is accelerating. Got that big jump last year. Free cash flow, 8.66% over the last 10 years. So very nice as well. EPS, 15.58%. Up and to the right. Love to see that. Now their debt is going to be a little bit high, as I stated. That is something that they're going to be working toward, and they are. At the end of Q3 2023, it was 15.57 billion debt, down to 13.71 billion debt. So they've cleared off almost $2 billion in their debt that was on their sheet. Their current debt level is 13.71 billion. Their EBITDA last year was 4.71 billion. So that is a little bit over 3 times. Not too bad. It looks a lot better than what it did. That is for sure. The dividend, I don't know why this big jump is here. I do not think that that is accurate. Either or. It has been growing over the last couple of years. It's kind of been stagnant since 2021. But with this one, it's a Canadian stock, so there's like currency conversion with it. But still, it is growing over time, which again, you want your dividends to be growing. You don't want to invest in something that's cutting its dividend in half or 60-70%, which seems to have been happening to a lot of companies in the past 2 or 3 years. Shares outstanding, so this is going to go up because of the acquisition that they made, where they got the Kansas City Railroad, I believe is the name of it. I wonder if they're going to change their stock ticker, because I think I've seen something that's like CPKS. I'm not sure. Either or, that's going to make their return on capital employed look a little worse for wear because of that, because they had to issue out shares for that acquisition. But before that, this thing was hovering pretty consistently around 14-15%. So, yeah, another one that I'm definitely going to have my eye on for my portfolio, because I would like to have it in there for the long term. Now let's take a look at the Analyst Estimates. So for United Healthcare, we got an average revenue of 27.72, growing to EPS. I am all over the place today. 27.72, going up to 29.65. I think that is right at double-digit growth from the EPS. Revenue, average, $298.32 billion, growing to $429.19 billion. Again, I think that's right at double-digit as well. McDonald's EPS growing from $12.20 to $13.29. I think that is just under double-digit, if I'm correct on my quick math. Revenue, $26.61 billion, growing to $28.16 billion. And with Canadian Pacific Railway, EPS growing from $4.18 to $4.96, and the revenue growing from $10.41 to $11.60. So that is everything that I got for you, and I hope you enjoyed that. Make sure that like and subscribe button for more. And until next time, take care. See you.